Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So the company I want to talk about today has reported its earnings about 2-3 weeks ago, and I've been waiting for the dust to settle so we can look at the company, because when it reported it was actually down quite a bit. So we want to make sure that see what basically the company has reported and look at the future and look at the past and everything in between, inshallah. But before we do that, as always, like the video, subscribe to the channel, let me know if you have any questions, as well as, of course, join us on the Patreon account where you get access to a lot of things, including the Discord, including the Sharia compliant investing ebook, and so on. So the company I want to talk about today is a US multinational professional and service company. This company does a lot of consulting. They talk to a lot of companies out there about their IT expenditure and so on, and they help these companies to use IT to basically grow their revenue and everything else. And the company I'm talking about today is Accenture. Accenture is one of those companies that we talked about it not long ago, and as you can see here, year to date is actually down about 5% when everything else is actually gone up quite a bit. So we want to see if there is a reason why this company was down, and how we actually look at the valuation of the company and see if it is actually a good opportunity for us to add to our portfolios as usual. Again, please do your own research, find out a bit more information about the company, and of course do your due diligence before you invest in any of the companies that we're going to talk about today. So when the company has reported recently, one of the things that happened was it went down quite a bit. And one of the reasons it went down, it was because the revenue estimates for the next year, basically they said it will be about 1 to 3%. The expectation was 2 to 5%. Again, this is not huge, okay, 1 to 2% or 1 to 3% or 2 to 5%, but that's what they were expecting. So the analysts were expecting 2 to 5%. The company said, sorry, we're not going to do that. We are reporting about 1 to 3%. So mainly they were so the company is saying it's about $16.25 billion that they're expecting in the third quarter, to 16.85, and of course Wall Street was expecting about $17 billion. Now, one of the reasons that when I've actually listened to some of their basically the aftermath of after the earnings, the lady, I think her name was Julia Sweet, she was talking on CNBC, and one of the things that she said is because a lot of companies have pulled back from investing in IT right now because they're worried about recession and so on. Now, think about this. Companies are not doing well. Because of recession, because people are worried about not being able to feed their own families and all of that stuff, they're not buying a lot of products. For that reason, a lot of companies are feeling that pressure, and for that reason, they're pulling back from things that they feel like they don't need to do right now. And IT probably for some of these companies, that's that one thing. So having said that, okay, the company has now come out and talked about how a lot of basically companies have now contacted them and said, can you help us? Okay, remember the company is a basically they do professional service and consulting, IT consulting side of things, which means these companies will go to Accenture and say, okay, this is, a couple of years ago, one of the things that Accenture was doing a lot of was the cloud side of things. Everyone was moving to the cloud. Basically, instead of storing their information locally, they stored everything on the cloud, which then helped them analyze that data. As soon as they receive that data, they can analyze it, they can share it with management and so on, and gives them a full picture, helps their customers, helps their revenue top line and so on. So a lot of these things has been happening the last few years. Similar thing now will be happening according to the company when it comes to AI. So a lot of companies have now come out, even chocolate makers have come out and said, how do we basically put AI into everything we do so we can actually leverage this thing? And for that reason, the company has now actually said, in the next couple of quarters is not going to be as bad as it was initially as they expected. And we will see what comes out. Again, they haven't given us any figures, but we will see basically what comes out of that. But a lot of companies are now going to this company and saying, okay, we want you to help us basically put AI into our system so we can actually help our customers, so we can actually make more profit, and of course we don't feel like left behind kind of thing. So we'll see what comes out of that. But again, it's a lot of talk. I've watched a lot of the CEO speech in the last few months, and it looks like AI is a huge thing. She mentioned quite a few companies they're working with, and because they're consulting business, they will go to those businesses and say, okay, this is what you could do, this is how you can adapt to AI in your portfolio products and so on, and hopefully help them basically make more profit that way and contacting customers and all of that stuff they need to do. And if you want to read everything the company does, from cloud side of things, from DevOps to HR to AI, you can pause the video and have a quick read. But that's in essence basically what we talked about now. It's basically the most important part. And like I've said, basically this is one of the biggest companies out there. It has a market cap of $200 billion right now, $209 billion. When it comes to what we're going to do now is we're going to look at the financial side of things, and then towards the end of the video I'm going to show you the estimation moving forward for the company, and then we will talk about valuation and if this company is a buy right now or not. So 209 billion market cap. It has a very safe dividend of 92%, 1.55% in terms of dividend yield. Now, in terms of the payout ratio, we're only looking 42%, and the 5-year growth rate of basically 11%. Latest increase was 15%, and the last 10 years they've increased that dividend 10%. They will pay you $5.16 for every share of this company that you own. They are going ex-dividend very soon, and you get paid May 15th if you actually own this stock. Now, according to the dividend theory, it actually looks reasonably valued right now, because it's 1.46 the 5-year average, and right now is the dividend yield is 1.55, and when it comes to forward PE, okay, 26.5, right now it's about 26.9. So again, it seems fairly valued at the moment. In terms of earnings payout ratio is actually good. Free cash flow payout ratio is absolutely even better. Earnings per share has been increasing every single year in the last 10 years. From 2014, this company made $4.52 billion to right now, per share $4.52 to right now $12.4. Free cash flow per share, again exactly the same, is heading in the right direction. And when you look at the shares outstanding, they're actually buying back their own shares, which is quite nice to see. Now, looking at the total sales or revenue, if you like, 30 billion in 2014 to right now $64.6 billion. That's absolutely massive growth, and this is what you want to see from this type of businesses. Now, return on equity, we're looking at about 27%. Return on invested capital, 32%. This helps us to understand, of course, how the management is actually reinvesting or basically how effective the management is when it comes to, of course, our capital allocations, like the money that we're providing for this company and so on. Profit margin, operating margin is already 16%. Again, it hasn't actually increased in the last couple of years, but as you can see, consistently just going up, which is quite nice. Free cash flow per share, 14% right now, which is absolutely fine. And this is where this company shines, absolutely no debt. And I'll show you in a second the current ratio, which is, I think, is 1/1 point, which is quite nice. And so yeah, so in terms of debt wise, absolutely nothing going on on that side of things. So now we have a bit of information about the company in terms of dividends, in terms of profitability and so on side of things. We want to look at the financials. We're going to look at, first of all, we're going to look at the revenue side of things. And this is what surprised me the most about this company. So total revenue from 2014, we've already seen to 2024, or basically trailing 12 months, is basically gone up from 30 to $64 billion. But this is the surprising part. So they're actually spending quite a bit in terms of the making that revenue. So the cost of that revenue, so this is what they spend in order to generate that basically that total revenue. So from 20 billion to right now $43 billion, which is in line of basically what the company has done before, but from gross profit of $9.6 billion to $21 billion right now, which is quite nice. But I was surprised about this because I didn't think they have that much overheads in terms of generating that revenue. I didn't think about that. So now we're looking at gross profit. So now let's look at the company will pay some taxes and all of that stuff, and we want to see what's left after all of that, and that is that $7 billion, which is quite nice. And it is growing from $2.9 billion to $7 billion. And we've already seen when it comes to revenue per share already, not revenue per share, basic EPS. We've already seen that. Now the other thing that also is when it comes to EBIT as well, it looks like from $4 billion to $10 billion right now, which is absolutely wonderful to see. And also that dividend per share of $1.95 to right now or basically $5 and so whatever. So it is actually good in terms of that side of things. Absolutely no worries, nothing huge to worry about in terms of liabilities. So when we look at the current liabilities, so the current liabilities is one of the things that we normally, current assets against current liabilities. And the reason we look at those two things is because we want to make sure that the current liabilities are things that potentially might do in the next 12 months, and we need to make sure the company has enough current assets to actually cover it. Okay, so we have $20 billion of $20.3 billion of total current assets. So we want to see the total liabilities again. So total current liabilities of $16 billion. So our current liability, current assets actually covers that, which is quite nice. So again, nothing huge to worry about in terms of that. And total liabilities about $23 billion, and total assets here, okay, is $51 billion. So it covers enough. That's so you wouldn't have to worry about when it comes to debt side of things. You don't have to worry about that at all. And the company has only $3 billion of total debt, which is absolutely fine. And now what we need to do is look at the estimation moving forward, and then we're going to look at the valuations, and we will end the video there. So let's look at the earnings estimate again. Remember, this is just an estimate. This is not exactly signs, or this is exactly what's going to happen. So just take it with a pinch of salt, because a lot of these basically analysts are over exaggerating at times, under exaggerating, whatever you want to call it. So 25, 26, and 15. So we're going to look at the first three. So you can see 4% in terms of growth side of things, which I was quite surprised about. And then 8% and then 12%. I was expecting at least 8% or more, but 4% for this year. Maybe that's why the reason is the stock's down quite a bit. 8.5%, 12%. Not bad at all. In terms of revenue side of things, we're looking at again almost about 2% this year, and then 7%, 8%, so on. So if what they're saying is true, and a lot of these companies come out and say, help us with our AI side of things, this company will generate more revenue, and this will definitely change. So keep an eye on the next earnings, because that's when a lot of the talk that they've made so far will either materialize or not. So that's one of the things that I'm looking forward to. And again, although they are one of the last to report. Earnings report starts next week, but they are one of the last to report. So we'll see what they come out with. And just before we move away from Seeking Alpha, we just want to compare this with its peers. Now, IBM is one of the companies, and Pfizer as well. So the two companies we're going to compare with are these two, as well as, of course, the S&P 500. And looking at the total returns in the last 5 years, as you can see, the company has returned over 100%. The S&P 500 is only 80%, 75% here and 75% here. And when you look at the last 10 years, 410%, 180, 50 something, and 471. So these two are kind of more or less similar when it comes to total returns the last 5 years, 10 years. But yeah, they've actually definitely beaten the S&P 500. And this is why I've always keep saying to you guys, just when you buy great companies, I'm not saying buy any companies and hold them for 10 years. When you buy great companies, they could have potentially a down year, but that doesn't mean the company is completely ruined. Okay, so you have to take these things into consideration. And now looking at Morningstar valuations, as you can see, it's 2 stars. That means it is expensive right now, about 13% premium. They're expecting $292 per share, but it's $230, so not far off. Okay, but easily can come down back, about 13% in the probably next few months if we see some sort of a correction. And then it's about the total return in the last 10 years. We're looking at about 16% for investors, which is quite nice. Every single year, that's what you would have made on your money. Now, according to Yahoo Finance, as you can see, next year they're expecting the earnings to grow about 8%, and then about 7.5% every year after that. The average price right now $389, so let's call it about $390, $333 per share is where the price is right now. So let's now have a look at the valuation side of things. So we have Morningstar valuation here, Simply Safe Dividend, as well, Simply Wall Street, as well as Seeking Alpha. and then we used the multiple valuations to compare it with IBM and so on. And then we used the discounted cash flow model to look at the historic cash flow, of course, and predicted how much cash they will generate in the coming years. And of course, we discounted back to the current price, and we're now looking at $333 per share, which is basically our current price. And the average intrinsic value is 315, which means it's about overvalued about 5% right now. Okay, now one thing I would definitely do is take into consideration some sort of a margin of safety as always. So that's about $300 per share. Again, that's not far off from there, but you might think, do you know what, it might be a bit risky. I don't know how the company will perform, if AI is going to be a huge thing for this company or not. The other thing I was worried about as well is, what if the company, because remember, this is a consultant firm. What if, for example, companies like Microsoft, Nvidia, and all of these AI companies decide to have a section where they can actually advise their customers? What happens to a company like this? It's not going to go out of business completely because they do have other things, but that could potentially happen with AI. Right, so $284 per share is not actually far off. So if we see about 15% correction, okay, which is basically what Morningstar is predicting, 292, so around that top basically price. So for me right now, it's not basically a buy. It's a hold for me if I had it in my portfolio, and I'll probably wait to see it if it goes below $300 per share, and then I will start looking at it, inshallah. Now, in terms of Sharia compliance side of things, absolutely nothing to worry about. In terms of business side of things, perfect. In terms of interest-bearing debt, we've already seen it doesn't have a lot of debt, and then interest-bearing securities is just also low. Now, I hope you're enjoying this type of content. If you are, please join us in the Patreon account, of course, where you get access to all of these things, inshallah. And like I've always said to you guys, it takes a lot of time and effort to put these videos together. I would appreciate if you can join us and like the video if you can't do that, inshallah. Have a wonderful day. Assalamu Alaikum.